Okay, give me a second. Okay, looks like we got our YouTube going. Just give me a second here to set everything up. Okay, looks like we got our YouTube going. Just give me a second here. Okay, so I am going to switch over to Zoom. Apparently we've done our audio check. Welcome everybody. All right, so tonight, wherever you are, we are going to talk about the patterns. The last set of patterns, about a month ago or a couple of weeks ago, I introduced the harmonic patterns, and they've been very effective in helping in timing and evaluating instruments. So I'm just gonna share my screen here and just know if you guys can see this okay. Can you guys see my white screen here with a type on it? That's my Office Libre. You could just give me a yay so I don't waste my time here. I want to make sure everyone can see it. All righty. Yes, you guys can see the screen. All righty. Awesome. Okay. So what we're going to do is we're going to go through some examples. Let me just pull up my browser here. I'm going to use this one called Epic. All right. So what we're going to do is we are going to probably have a short session. And what I'm gonna more talk about this and try to keep this as a open discussion for everybody involved. And if you got any questions, let me know with the chat and all that wonderful stuff, and we can move ahead. All right, so the first thing is I want to just rewind a little bit and let you know that a lot of these patterns come from a Facebook group called Nick Trades, and her name's Nicola, and she basically trades, has been trading for at least 6 years. She's a professional trader. She runs a session every Monday night out of the UK, a couple hours before this one. And she focuses on cryptocurrencies. And what I've been doing is I've been reverse engineering a lot of her methodologies to carry out the different patterns. Because up until this point, I have been using sub 5 minute with Dukas Copy Data and JForex, their proprietary platform. And I've been, to be honest, I've struggled quite a lot trying to figure out how to get that working. Too many negative positions that just fail, and it just wasn't worth pursuing because I didn't see any real benefit to it at this point. So I started following Nick Trades, and a lot of her stuff follows with Fibonacci, moving averages. She also uses harmonic patterns, which, like I said, I talked about. And she also uses the ones I mentioned tonight, which includes head and shoulder. She also uses wedges, flags, and pennants. So I'm going to go over these, and these are very high level. I just want to get your opinion. You're more than welcome to chime in at any point to let me know what you think, or if you got any better advice to give, we can do that as a group. All right, so the first one is a classic head and shoulders. Now, to make sure we understand this, when it comes to technical analysis or technical patterns, the word is this is not an exact science. It's not meant to be. But my whole view of trading has totally changed, where the idea is before you put on a market entry, you're going to set up a a target before you put on the entry. And there's a variety of different factors that will help you make that choice. And once you hit the target, there's different levels of targets using Fibonacci levels, as well as a combination of moving averages and the patterns, because there's so many different variables when it comes to pricing action and setting the entries. What probably the hardest part is out of the whole thing is that because pricing goes into this this random walk, it gets very confusing for people, and they get frustrated very quickly because the random walk throws them off, where they think there'll be a reversal or a pivot in the market, and it doesn't work out that way. But when you add in, or I should say layer in, these additional patterns, it can help filter out those very bad trades. So we're going to look for a variety of different patterns to sort of that can be used historically to be able to pinpoint proper entries in the market. And then the exits, you can also use these patterns on top of, you can use average true range, which I've been using, and that works pretty good. And then apply, let's say, a trailing stop or a stop loss, whatever you are comfortable with and how you're trading. So as I said, the first one is a head and shoulder. The big one that everyone, if you come from the world of working with retail trading platforms, you're just working with a chart and then a pattern, but you never look behind the math. So in this link, and I'm going to put these in my Zoom chat box. I can't do it on my YouTube. It's a different system, but it is available on my Zoom session. So what we're doing here is, as a very simplistic point of view, with the head and shoulder, what we're looking for is the algorithms that are used to create these patterns. And it's these values that make a difference. Now, what I can tell you when it comes to head and shoulders or any of these patterns, it's very simple. You take a high and you take a low over a certain set of data, be it end of day, be it if it's hourly or on a 4-hour basis. You want to take a certain range, and we'll talk about these ranges in other patterns. But usually the key here is that most of these patterns are taking the highest high, the lowest low, and measuring the distance, and then basically halving it in half, and then using like a 1.5% of an average between the highest high and the lowest low. And then you can mimic these different patterns to be able to say, this may work, and I can set that as a pricing target. So that's something you can definitely look at. And usually it's not very complicated. It's only a halfway point between the highest high and the lowest low. It's that simple. And that is the metric that most of these professionals use to gauge targets. So if there's a highest high, lowest low, and it breaks from the lowest low, the half point, that can be considered not a breakout, but if you apply the Fibonacci retracement levels at that point, then you can set a new entry point using the different retracement levels for your next entry into the market, because you're using a historical pattern to gauge the performance. And I'll go into better examples of that. But this is just one example of how you can calculate the head and shoulder, and not just a visual representation of it. You always want to, when it comes from the automation point of view, you want to be able to use the halfway point, and there's usually a halfway point on that pattern to mark, this is where I want to apply my Fibonacci retracement. So as I said, if anybody has any questions, by all means, you can jump in, and we'll make some comments. See, RF is saying thanks, no problem on the links. If you want the links, just jump over to the Zoom, and we'll get them over there. All right, so the next one we are going to talk about is a good example. Okay, before I forget, on these pivots points in in GitHub, let me just pull up my old Google. There is a project in the Python, because I'm not going to get too much in the programming side of it tonight, but I'm hoping to show you some references that you can use in the future as I attack these different patterns and be able to demonstrate them using a Python script. But one reference that you could use is zigzag. And here in these points, what you can do is you're trying to, as you can see here, you're trying to determine the peaks and the valleys in the data. So you can use this one project as one methodology to calculate these peaks and valleys. And another way is to get the historical and just do a simple min and max. It's that easy. And for me, with the patterns now, I just try to keep it very simple so I understand it without doing any really weird math to accomplish some kind of trading pattern. Okay, so the really important one I found is what they call the zigzag. Sorry, not the zigzag, the bull flag and the bear flag formula. So as I said, there are the different trading rules that you can apply, and this can be applied to any trading platform. So I'll put this in the Zoom. And basically what we're dealing with is, just jump over to it. So this particular link that I found is specific for bull flags and bear flags. And this is really useful when you have a pattern that's forming and you apply a set of rules to say, are we in a bull flag or a bear flag? And I'm going to show you some better examples for this. And these are the rules right here. But this one comes from the actual trainer of the software. So this is, I would say, more official. So as I said, you got the link in the Zoom session. And you can see here, if you were to follow these codes, the PCF codes for this platform, let me just pull it up here. So what we're dealing here with is quite simply the average on the close. Okay, so this is to determine if you have a bull flag. You take the average of your data. If it's, let's say, the closing day data, end of day data, you take the average on the close of the 20, average of the 50, and you take the hourly and the 4-hour and this is the hourly high and the 4-hour high. Also, you have the hourly low and the 4-hour low, and the 2-hour and the 4-hour. Sorry, I'm always getting these confused. This is the high, hourly, 4-hour high, the hourly low, the 4-hour low, and the 2-hour high and the 4-hour high, and the 2-hour low is greater than the 4-hour low and the 3-hour high, and so on. Okay, and then here's your minimum L3, 3-hour and 4-hour low, and the 4-hour high and the 4-hour low as well, and you divide those. But here's the general formula, the trading rule. And once this condition is met, you pretty well have a bull flag. And I'm going to show you what that means. Okay, so this can help you filter out those bad trades. So when you watch the pricing action as it forms, no matter what period, but really this is really meant for closing end of day data with the hourly and the 4-hour. You can apply again the same set of rules and conditions for the bear flag. So if I load up the rules, which is okay, sorry, this is for the wedges. So I'm going to show you. Let me see if I can copy this. hopefully this will set this set of rules that I'm looking for. Okay, so what we're looking for is baby pips. I learn a lot on it when it comes to patterns. So if you look for baby pips, let's call it a bull flag. So to learn about the bull flag here as an example, there's numerous examples that you can use to show you. And this is what a bull flag looks like. And this is a smart way to say you're going to have probably a high probability, historically, probably an upward move. Okay. So if you take those set of rules, you could probably get a one way to filter out the bad trades just using this condition I just showed you at this link. So I'll put the other link here in the Zoom session. All right, so that's what you're kind of looking for to help you go when you go into this random walk session, but yet on the long term, you do have an upward or a downward movement. And you can use that to say we have a bull flag or a bear flag, just one of the many examples out there. But this is a very typical flag trading pattern you're going to want to look for when it comes to downtrends and uptrends. But you can get even more precise with that. So the other one that's probably out of all of them that from the coding perspective, from what I've seen, wedges are the more complicated, and there's more conditions here that you can use. So let me just show you that. So I'll give you this link in the Zoom again, Zoom chat. Okay, so let me pull up that link, and this is a really nice description of wedges. So here are the wedges, and again, chime in whenever you want, either the YouTube or the Zoom session. So I'm not going to go through this in detail, but the wedges are really good because we have an uptrend, we have higher highs and higher lows forming. So historically, we can determine if we want to put on a market entry or not, or just wait and see what happens further, because sometimes you can get these uptrends, and then all of a sudden the wedge will break down, and it may not form into what you want. That's why you have all these multiple different patterns that combined, you can see, oh, this is a setup for something. We don't know what yet, but watching the combination, we can generally determine that maybe there is a market entry opportunity forming. So here in this example, we have a downtrend, and here it's saying if you have this type of higher high or higher low, you could have a bearish continuation signal. I can never say that. My apologies there. And so again, as I mentioned, that the price can break down and your downtrend can resume. Again, as I said earlier, this is not an exact science, but what we're doing here is we're trying to determine ways to watch the markets as they form and be able to determine, do we take the trade or not? But we have numerous trading patterns that we can use to determine where the price is going. And based again on historical patterns, we can determine if we're going to take the trade or not. So right here, again, in this example, the price broke down to downside and downward continued. That's why it's called a continuation signal. Okay, and again, this is on baby pips. It's a great way to learn about trading patterns. This is just one of the few that I'm going to focus on, but that seemed to work for a lot of the professionals. And I've been playing around with it, and it kind of works really well historically. When you watch it, you play around with these. The other thing is we have, as I said, the reversals, a downtrend, or it will go into this continuation mode. And again, what we're looking for is the bear and bullish conditions or the patterns. So again, there's these various kinds of wedges that you can use, like this case, a falling wedge. A falling wedge. So the previous one was a rising wedge. This one can be determined as a uptrend or will form as a bullish trend. And again, there's various reasons for it. So here in this example here, lower highs, lower lows can be, I'm going to stress the word can, is a bullish condition. And it's a reversal condition. After a downtrend, the price made lower highs and lower lows. And sometimes that may get steeper in the trend and then it'll pop up like this. And I've seen that numerous times. And these are the exact conditions that I'm looking for, because if you can get your trade right in here, and as it pops up, you hopefully will hit the low entry and then be able to ride it up as it moves up. So as an example, when I was watching the Dukas copy data for basically Dukas copy data on a 5-minute chart, what would happen is exactly these scenarios. And it would happen not a lot, but when it happened, it would ride up to 10 times the original position, and you get amazing returns with that. And that's the sort of thing we look for, is this exact trading condition. Again, the probability will be hopefully in your favor when you see these type of patterns. This is kind of like what you're wanting to scan for. And again, we're using end of day data. So I've provided the baby pips link for this, so it's all in there. Here's another one. This can throw you off where you do get that pop, and I see this all the time. And we mentioned falling wedge from an uptrend usually signals that the trend will resume later on. And as it consolidates, it pops again, sometimes. And again, this is just another way buyers pause to catch the breath and probably recruit more people to join the bull camp. Or from an automation standpoint, this line right here is another way of saying people or algorithms are suddenly seeing that pattern. And as a result, they join in later on after the initial move. So you definitely want to be down here instead of up here, obviously, because you're going to get more profit, and you may be able to actually get out of the trade earlier as more people pile in. That usually takes away the opportunity for further profit. You might get, from what I've seen, 3 or 4 of these kind of intermittent pops, and it suddenly dries up. But it's these huge moves, these big bars that can really do well for you. And I've seen them, if you leave the position on overnight and this position you put on automatically, and this condition continues, you can make mad money with this. It doesn't happen a lot, but if you do catch it, you can do very well. Doesn't necessarily mean you'll do that all the time, but again, these are just patterns based upon historical pricing action. We have, again, that same example that I told you. We get a pop here, another wedge, and it pops up again. And I'm sure you've seen this numerous times. And this can actually happen on a sub-minute level as well, or sub-5-minute level. And the question is, will it climb higher? But as long as you're sticking with these kind of patterns, you'll be able to determine when to get out, and you'll be able to confirm them as more people pile in. So these wedges are really, really powerful if you know how to use them and get in at the right time. So Dolph PKS, have you back tested this indicator? I can't say I've back tested. It's a good question. A lot of this type of back testing cannot be done. But I'll tell you this, I spent about 4 months testing this in a sub 5 minute time frame. And I see these all the time on different types of Forex pairs. And I couldn't quite explain it. And you really can't back test these because these are so random. And that's the problem with the market. It's very hard to predict these. There's no reason or rhyme or reason why they happen. But as long as you understand the power of these type of patterns and what to look for, and being able to combine other indicators to confirm if this is actually happening, as I said, you could probably do pretty good. As I said, I've put the link in there. But here's the problem. When you have these different patterns, especially the rising wedges, they can definitely throw you off. But again, the more knowledge you have, the more power you have in terms of building out your strategies. And usually you want to always look for the breakouts. And these type of wedges, the falling wedge especially, will help you in that, because it's usually a bullish condition. But there's something that I need to tell you. What you'll have here is, if you have this condition, you can see here we have 2 legs, right? We've got 1, 2, and potentially 3 legs. What can happen here is, if you have, let's say you're a broker, in my case, Dukas, Copy, whoever, for FXCM, whatever, you're usually going to have probably a few hundred algorithms watching this trading pattern or this trading condition, call it whatever you want to call it. And what happens is, if there's a big wig trader, what they'll usually do is they'll try to manipulate this trade play or this trading scenario. So what they'll do is they'll put in a small position, get the price to pop, let it fall again, put another position in, or partial position, let the pricing action rise again, and then for the third leg, as you got here, 1, 2, and then a third leg. So by the time we get to this point, a lot of the algorithms of smaller participants in the market will have been shaken off and be scared off, thinking that the price will not actually happen, or a breakout will happen. Usually it can, but it can be anywhere from 3 to 5 of these pricing legs. And usually what can happen is a big whale trader that's got a big account, who's automating their trading position and especially their position management. What they'll do is they'll put, as I said, they'll put in 3 to 5 different partial trades positions to shake out those weaker participants. Because the fewer people that are in that position and watching that opportunity, and when that big whale trader finally jumps in with a full-on position, that's when the breakout will happen. And I've seen that numerous times, and people in my Telegram group tell me the same thing, that they see it, they can't understand why, but once they understood that, it's usually probably a whale trader who's manipulating that order or the positions. They go, yeah, that totally makes sense. And that's what the more smart money does to shake out the weak guys or the insignificant participants in the market. They're trying to shake you out on this opportunity, and then all of a sudden the breakout happens, and then we get all these other wedges as in this result. So I just want you to be aware of it, and you usually just want to watch it, let the 3 to 5 legs form, and hopefully on that final 3rd or 5th leg, that's when the breakout will happen, if this pattern is still forming. Otherwise, you know that, as I said, you may get a breakdown after what you think should happen. So I'd wait it out a little bit, and as it consolidates and as it tightens, you wait it out. And once that whale trader has figured nobody's following it anymore, then they'll go in full hog and put in a big position, and it breaks out. And that's usually what will drive these big bars. And then by the time it gets up here, the big trade, the big whale traders may let these wedges, maybe 3 or 4 of them, form and then get out. And then, by the time that happens, the dumb money has figured, oh, there's a pop, and all of a sudden think that there's an opportunity. And it may continue to go up as more people come in. It's a supply and demand that will drive it up. But the real big whale traders, that's what they do, is that they'll let this position have 3 to 4 or 5 legs, shake out the weak players, and then finally pop it. And then they'll initially let it ride for about 3 to 5 legs up on these different types of wedges. It's very random, but that's usually what will happen. And you can apply the same thing when it comes to crypto, because this can be applied universally. So this is why I'm keeping it sort of secretive. And if you guys are part of the Planet Action, that's pretty cool, and I appreciate you being here. But please don't share this. The more people know about it, these sort of things are not as effective, because a lot of people will tell you these wedges and these flags and pennants don't work. But from what I've seen, they do work, and the professionals want to keep it that way. Okay, so let me see what else we've got. So we've talked about the wedges. So here's the general rule when it comes to I'm going to put this into the Zoom session here. So the general rule when it comes to wedges is the duration of the wedge should be a minimum of 20 bars. Again, that would mean 20 days. With fewer than 20 bars is considered a pennant. And again, here, if I go to this link, you'll see what a pennant is, and that's what we talked about earlier, which are really the bull and the flags. And here, we can go back into the general rules here. So these are all explained here, and I'll put that in the into the Zoom as well. So again, here, duration of the wedge should be minimum 20 bars, blah, 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 blah. And these are pretty good explanation of these different continuation or falling or rising wedges, or if they're reversal or not. So I did some digging for you, and this is what I came up with so far. And this one's not a bad link as well. Let me put that in this Zoom session. And like I said, anybody can chime in anytime they want. So again, I think this is a different explanation of what I showed you before. It's not the baby pip. This is stockchart.com. So let me see what else I can throw your way. Oh, and then there's this. This is a really good Wikipedia link as well. Okay. So hopefully I'll load up. For some reason, these are not loading up. Okay, so here the wedge pattern, again, the falling and rising wedge patterns are explained. I think this one's not loading because of my proxies on, but as I said, I've given you the link in the Zoom chat. So this one probably not as detailed as the other baby pips link. So that's about it I wanted to show you. Who's got questions, or who's got some answers or commentary on this? Because I like to present these as a group. There is 8 of us, 3 on YouTube, 5 of us on Zoom. So who has any questions? Anybody at all? I've got both my chat modes open. So again, for my next set of steps, what I'll be doing is I'll be automating these. My source code's coming from MetaTrader of all sources. So the question is, why isn't this testable? Arby asks that. Why isn't it testable? Okay, so the question is, I guess you're asking, why is this cannot be back tested? Well, I personally think it can be back tested, but from what I've seen, a lot of the pros don't bother with back testing, because back testing is just doing a lot more work than as opposed to just running a coded up algorithm in demo mode and running your code against a real, not live scenario, but a demo mode with live data. So you can see things happen in a random situation as opposed to different historical. And the reason I can say for both crypto and Forex, you don't really need to do back testing. The reason why is because unlike stocks or futures, they're based on trends. So they're heavily dependent on momentum, is dependent upon news. So let's say, for example, you wanted to back test stock index or some kind of stock in 2008, and yeah, you can back test those time periods because those are extreme downward moving data points. So that's fine and good, but we're dealing with Forex and crypto here. So we don't have periods like that. It's always random. You might get 1 or 2 day moves based upon, as an example, Friday, where the Bitcoin and crypto went down, but it comes back. It's always news driven. So there's never these consistent trends that you'd get as in time periods of late 07 through 08, where there was a financial crisis. So backtesting is pretty tough to do. Not tough, but I mean, there's no general downtrend in crypto or Forex that I've seen. It's always random, and it's such a big asset class that you can't manipulate it. So I personally, this is my view. You're better off to just run it and stress test it and put it in a demonstrator, put it into an account that's a demo account, and just run it against that data. So let me go on to the YouTube. I got a question here from Holy Crypto. Appreciate all the questions, by the way. How you actually use it and gotten profit from it? I don't know when you joined, but the idea, what we're doing here, unlike quant or data science, is we're not predicting where the market's going to go. What we're doing is we're setting targets. So based upon that, which is a totally different view, I can't tell you if it's profitable or not, because starting this week, I'll be testing it actually with live money, because it's a totally different way of trading. Like I said before, I've been using methodologies for about 3-4 months trying to trade off of sub 5 minute, and it failed. And I already explained why it was failing. But this type of methodology is totally different, where you're looking for targets. And once you hit that target, that's when you enter in the market. So it's a totally different type of trading view. So I got to test this out, see if it works or not. And I think it does, because I've tested it against a variety of data and different scenarios, and it works so much better than call it quant or high speed or all these deeper analysis, more complicated ways. I'm not sure if I answers that question for you, Holy Crypto, but if I haven't, just type away again, and I'll see if I can respond in a better way for you. Okay, so RF has been asking, I have seen many times where the wedge patterns breakout was wrong. As I said, RF, we got to combine these with other patterns and other conditions. One of the big ones that I've worked on is just simple moving crosses of a fast and a slow, and it's just another form of combining and layering these different indicators to confirm that you do have a market entry potential. And yeah, you're right. If you use it exclusively, if you're using wedges exclusively to set market entries, which is not smart. If you combine it, and you may have a harmonic pattern that may show, and combine between this or a flag or a bullish flag or a bearish flag versus a harmonic trading pattern, which confirms between the two that you do have a bear or a bullish condition. So you got to combine them. Can you share stats on how many times the wedge patterns was a good indicator versus wrong indicator? The stats I can't show because I haven't done enough testing on this. It's just a new area I'm moving into. So I'm using these sort of sessions as ways to improve it. I'll be hopefully showing that once I develop the actually it's 3 scripts in Python to show these. Once I can show these patterns combined with the harmonic patterns, it will radically raise my confidence, because part of the problem for me when I was trying to trade on sub 5-minute levels, I was more guessing than being able to use real valid data. But combined with these different patterns to say yes or no, that you do have a pattern here or a harmonic pattern in conjunction, that can just raise your trading confidence in those trading conditions. I'm referring to stock wedge patterns, not FX. I think wedge patterns are very tough to do, because the reason I think wedge patterns may not work for stock is, as I said earlier, if you're going to try to back test data or market data, and you are in a downward trend or downward momentum, like in 08, 09 with the financial crisis, I really think that your wedge patterns are not going to work, because you're in a market regime where it's all falling knives, and you're trying to use a wedge pattern that will not show the conditions of what you think it should be, because you're just kind of like using it in the wrong conditions. But whereas if you try to use this for, let's say, Forex or crypto, I think it's going to be more accurate. So RBS, but your losses are dependent on anti-trend. Again, that's if you're using the perspective of using, I would assume, wedge patterns, or all these patterns I'm talking about today exclusively. You have to combine them with other trading conditions, or sorry, trading indicators. And usually when you layer it with moving averages, it really will solidly confirm your theory on a market entry position. Because time and time again, when I go into and analyze these type of scenarios, I'm always thrown off, and I can guarantee you probably most of the time you'll be thrown off as well. So these are just methodologies to make it better, filter them out, and just wait to see what happens, to see if these pricing conditions do hit your targets that you set from, again, that I was mentioning, from the Fibonacci levels that you can apply. I've already done demos on that a number of weeks ago. And the real condition is this is just a tool, but you want to use the Fibonacci retracement levels as your ultimate confirmation for targets, be it for the exit or the entry. And this is just to help you to gauge what's happening, and using, as I said, predictable patterns that you have, what could happen. And that's what also the harmonic patterns tell you as well, because you may start to see predictable patterns like ABC or Gartley or a bat or a bull. So it's all these combinations of patterns that you will try to help you determine of what's happening. Now, again, coming back to Arby, I'm trying to understand really. He's saying that I'm dependent on anti-trend. Again, hopefully I've answered it, where you're using a combination of trading indicators. As I said, I'm using Fibonacci as a big one. Moving average is another big one, but these patterns are secondary, and this is just part of those secondary suite of tools that I'm showing you. But I put more emphasis on the Fibonacci moving average to really confirm my theory on the market entry. And usually on the exit, I just use a trailing stop and or an ATR as well. And you could also reapply these patterns to see what may happen, and look for certain patterns and try to gauge what could happen on the exit. But usually ATR and the trailing stop is all you really need. I'm not sure if I've answered everybody's questions here. If you got more questions, let me know, or any comments. Again, this is my first stab at this, but I just wanted to show you from a high level what I'm trying to do, and hopefully you guys have really helped me determine and filter out a lot of questions I may have. But like I said, we're using these patterns to sort of filter out the bad potential trades. And the other idea is we're going to be running these scans daily, hourly, and be able to make better decisions on these patterns as again, as part of an entire suite of other indicators and that I've already mentioned. So anybody else got any questions or concerns? If not, I can do it going once, going twice, 3 times. Okay, in the meantime, next Tuesday, downtown Toronto, myself and Dr. Ernie Chan will be talking at a big broker. They wanted me to keep the name of the broker, but I'll just say the data is FXCM. I'll let you determine the rest there. It happens downtown on Tuesday. We've got 20 spots left. We've already registered about 80 people for this thing, so it's a big talk between me and the and Ernie, as well as FXCM themselves. RFS, will this be streamed? I've asked on that. I don't think it'll be streamed, but they did say it will be recorded. And they've got a new website called QuantNews.com. And I would imagine they will probably professionally record it and get it posted on that website, because they're using that website as an aggregator of news, and they'll be able to bring in new potential clients using Quant, or the name of Quant on this QuantNews.com. So that's next Tuesday. And my next week, I'm hoping to focus, Ken Weber, the URL. Oh, let me type that up. I believe it's quantnews.com. Yeah, let me just go over there just to confirm that. I believe it's quantnews.com. Yes, it's quantnews.com. So all of that info, that they do webinars and stuff, so we'll probably post it here at this website, the one from next Tuesday. I don't know when, but that's what they said they'll be doing. No problem, RF. Anybody else got any questions? So not next week, but I think the following week, in 2 weeks, I'll be working on Dukascopy, showing a course, and I've got all the videos already recorded, showing you how to use the API from Dukascopy, as well as their platform, the J4X, which is proprietary. And it works quite well with Java. I'm getting to know that API pretty good, and I'm really digging Dukascopy. But there's a lot of advanced uses that you can take away from it using it with an IDE like NetBeans or Eclipse. And I've not ever seen this with a retail broker ever, with the exceptions, of course, with Interactive Brokers. But it's a very advanced broker. They've worked on this for well over a decade. You show the different methodologies that are available through Dukascopy. Also, if you're a non-programmer, they have a tool called Visual J4X, which enables you to create trading strategies through a visual tool using Flash, and just build all the different blocks of the different components that make up a trading strategy. So if you're a non-programmer, it's really good to help you get into the mindset of how to build a trading strategy and algorithm. And there's some other really cool stuff that you can do where it's community-based. You got over a few thousand different strategies that you have access to. You can also enter a strategy into a contest. The prizes are quite generous at $30,000. And I think they give away some pretty pricey watches as well. They'll fly into Switzerland, blah, 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 blah. Really cool community. So I'm going to do a course on that in the next few weeks. And also, I want to focus more on the charts now, that once I get all these tools developed. I'm not sure if you've seen all my videos on my analysis stuff on the ability to watch literally close to 100 assets now that have the capabilities of doing that through Dukascopy. One other thing I should say about Duca's copy as well is if you are not in the States and you want to have an account that's actually protected, Duca's copy now has Duca's copy Bank, which is registered and regulated by the Swiss government. So when you open an account with Duca's copy, that account is now protected by the Swiss government. So they will protect you of up to 100,000 Swiss francs. I'm in Canada. They only protect a trading account of up to $60,000 Canadian. When you convert that 60 grand or 100,000 Swiss francs to Canadian dollars, it's over 120 or 140,000 Canadian. So it's more than double protection that I get as if I was to stay in Canada. So that's a huge advantage that Duca's copy has now, that you will have your account protected by the Swiss government. And the cool thing about it is, yes, you have to start with $1,000 US, I believe, but you get the protection from the Swiss government. And now you have the ability of that as a benefit on top of the API tools and all the platform itself. It's really good. I don't work for any of these brokers, but I'm just telling you what I like and what I don't like. So there's that in a couple of weeks. So if you got any questions on that, let me know. And again, just generally from a trading perspective, the commodity field is supposed to blow. It's supposed to be the hot asset class to be in. And with Duca's copy, you have the ability to trade what they call CFDs. I've played around with CFDs. They're supposed to mimic the underlying asset or commodity. So if you want to trade oil, gold, silver, Bitcoin even, some of the indexes, you can do that through the CFD option, through Duca's copy. And I watch almost 100 assets between the Forex as well as the CFD. And I will tell you, I see some really big moves with the commodities space, especially in oil and obviously in Bitcoin as well, through the CFD, if you want to trade through Duca's copy. So I'm going to be having that, creating that course for people, but I think that's going to be a strong area to be over the next few months, as well as obviously crypto will always be a really good space to be in if you know how to make the calls. That's pretty well it for me. You guys got any further questions? As I said, I appreciate everybody watching and participating. As I said in my email, I won't have a replay unless you're a member of mine. And even if I do that, I'm only going to make it available for 24 hours. I'm hoping you can appreciate the reason why what I'm showing, because this stuff appears to work. I'll be able to validate that, and I'll have more of these kind of sessions on Monday nights or at this time over the next couple of weeks to showcase my results. And that will be starting out with crypto and then eventually applying it to Duca's copy for both CFDs and Forex. So I'll have better answers for some of these questions later on. So if anybody's got any other questions before we give her a wrap, just coming up under an hour, which is awesome. Anybody else got any questions? These questions are great. I hope I didn't disappoint one with the feeble answers I'm giving. Just trying to be upfront and just give you my view on what works and what doesn't, and try to filter out the potential bad trades and the high potential of bad trades. But I think these type of patterns will help filter out those bad trades. And it's a totally different type of trading that I'm approaching. I'm not using quant as much or pure technical. It's about setting targets, and that those targets are set by the Fibonacci retracement levels. And as I said, I've got lots of videos on those on my YouTube channel. So as I said, anybody ever got any questions or comments? What I'll do is I'll make this available for 24 hours through my membership. No problem, Obenti. I'm sorry if I got your name wrong. No problem, dude. Appreciate anybody participating. I always love engagement. That says a lot about you that you're halfway there. Anybody got any questions or comments or any educational pieces? I can blab for a while if you want. So I'll do a going once, twice, going three times, and then we'll shut her down. That's how I usually do it. So I'll do a going once. Anybody got any questions or comments? Hopefully they're typing away. Go ahead. Going twice. Going 3 times. I guess not. I guess we are done for the night. All right. I appreciate everybody watching, and we shall talk to you later. Have a good night, guys. All right. Thanks again for participating. I'll talk to you later.